Hello, and welcome to another episode of Money Script Monday. My name is Luke Geller, and today we're going to be talking about how should you fund your IUL, with your money or theirs. And really what that means is, hey, if you're looking to purchase an IUL, you already know exactly what you're looking to buy. How should you pay for it? Well, you can pay for it with your out-of-pocket premiums, or with premiums out of your own pocket or your own bank account, or you can even add to that and utilize bank financing to increase that spending power that you have. So think about it this way. My fiance and I are looking to purchase a vehicle, right? We know exactly what vehicle we want. We want a 2022 RAV4 XLE hybrid vehicle. It's a pretty expensive car, right? Well, we could pay for that entire car out of pocket, but should we? Well, we could also finance that vehicle through a bank, right? We can pay maybe $10,000 down out of pocket and finance the rest over a 5 or 6 year period with the bank. Or we could even lease that vehicle through the dealership. So there's 3 different options we have. And what we're going to do is we're going to sit down, we're going to look and see what we qualify for and what the pros and cons are of each. And today we're going to do that exact same thing, right? But instead of a vehicle, we're going to look at an IUL policy. And first, what we're going to talk about is we're going to see, hey, can you qualify to finance a portion of your IUL premiums? 2, we're going to look at pros and cons. And then finally, we're going to take a look at a case design of finance versus a non-financed index universal life policy. So can you finance premiums? Well, there's a couple things you need to think about. Basically, it's your net worth and your income. And where that starts is, hey, if you make over $100,000, but not quite $200,000, then you need to have a net worth of at least $1 million. And then if, say, you make $200,000 or between $200,000 and $400,000, you need at least a $500,000 net worth in order to qualify for the bank to also put a portion of premium dollars into your IUL policy. And then finally, if you make over $400,000, then you don't need to have a net worth qualification, right? So really what we're looking at is, hey, you need to make a decent amount of money and you need to have some kind of net worth in order to qualify for this. And the reason is, we need the bank and the insurance carrier want to make sure that they aren't putting you in a bad position and having you spend too much of your money or maybe have you spending too much of your money that you're earning on premiums to fund an IUL. So it's just looking out for your benefit and your safety, right? So now that we know, hey, I do qualify, let's take a look at some pros and cons, right? First, we're going to look at the pros. Well, the big one is you're getting 3-to-1 leverage on your money, okay? And so what that means is, hey, if you put $50,000 in premium out of your own pocket, the bank's going to match that premium and then even add more onto it, right? So you're getting a 3-to-1 leverage on your money. And also what that means is that's going to increase the death benefit to the policy. It's going to increase the cash value, and it's going to give you higher potential tax-free loans out of the policy for retirement. So that's huge, right? You're increasing your death benefit, the cash value, and the money coming out. Sounds amazing, right? Well, there are some cons, and we want to take a look at that, make sure you know exactly what you're getting into. The first one is you're losing control of your money for at least 15 years, and ideally, think about the example I gave you earlier, right? If I'm purchasing a car, but I'm using bank financing, I put $10,000 down on a $40,000 car. The bank also put $30,000 of their money into that car. Well, I can't just go sell that car, pocket all 40 grand. No, $30,000 of that is the bank's money. So same thing here. As you put in premiums and the bank matches those premiums, the bank needs to be made whole. So you can't just go into that policy, pull out cash value as you want until you pay that bank back, which is usually in that 15th year. Now, on top of that, you're adding additional risk, right? And what that means is you're adding an additional lever to than if you were to just pay the premiums yourself. There's a whole loan component with an interest rate and a bank involved. And then once you do pay that loan off, now you don't have the loan to the bank, but you have the loan inside your policy. So if you have multiple 0 years or you don't earn any interest inside that policy for multiple years, that could put a strain on the policy. It could potentially lapse, and I don't think it would, but you have a higher risk of that happening if you leverage that money and borrow that money from a bank and have a loan on the policy than if you just pay it completely out of pocket. And then finally, there's a longer application process. A normal IUL would usually take about a month or 2 months to get through underwriting and get enforced. If you're adding financing and a bank into the equation, banks do not move fast, basically about the same speed as insurance companies, right? So you're looking at another 2 months on top of the timeline there. So probably about 3 to 4 to 5 months just to get your policy in force and make sure you're protected. So keep that in mind as well. So we looked at, hey, do I qualify for this? Talked about the pros and cons. Now let's take a look at an actual case study. And keep in mind, this concept we're talking about today is more focused on the smaller case premium financing platform. So we're not talking about 10, 20, $30 million death benefits. We're looking really between $1 and $3 million death benefits. And in this case, we have a 50-year-old male, preferred non-tobacco. He's going to put $76,550 of his own money out of pocket for 5 years. So he's putting just short of $400,000 into the policy. He gets a $1 million death benefit and at age 66. So he funds the policy for 5 years, lets it grow for another 10. And then at his age 66, he's pulling out tax-free loans of $55,417. That's not bad, right? If he lives to life expectancy for preferred non-tobacco age 50 is probably around 85. That's about 20 years of tax-free loans. So you're getting about $1 million for a $400,000 investment. Not bad at all, right? Well, let's take a look at the financed option. This client's putting that same $76,550 out of his own pocket. But what else is happening is the bank is matching that premium and then matching that premium for the first 5 years, and then paying the entire premium for years 6 through 10. So they're putting in $76,550 on top of yours for the first 5 years, and then basically paying $150,000 years 6 through 10. So now instead of just $400,000 going into the policy, you have over $1.5 million in premium going into this policy. So you're borrowing about $1.1 million from the bank. That allows you to have a death benefit year 1 of $2 million. And then once you pay that loan back at year 15, you're taking out $103,000 of tax-free loans at age 66. So what that means is, hey, same out of pocket, doubled death benefit, almost doubled your tax-free loans. So it's pretty lucrative, right? It is beneficial to do that, and there is huge benefits, huge income benefits, increase your money. You're utilizing your money so efficiently that you're able to put the same out of pocket but double your benefits. All right, so now that we looked at the case study, again, you have some huge benefits that you can get. You can double your death benefit. You can almost double the tax-free retirement premiums you have coming out from the policy. But again, there are risks, there are concerns, and that's why it's so important to talk to your financial professional about this strategy, right? If you're going to do this, you want to sit down with your tax professional, with your family, make sure it's right for you, and that you're looking at all the things that can be benefits for yourself. So I hope that you were able to take 1 or 2 things from today's lesson, be able to incorporate it in your decision and your decision-making process. And again, thank you for watching Money Script Monday.